You can probably expect within the next few years to be paying $10 to $15 for a gallon of gasoline. That is just destiny.
At GoldSilver.com, we have a price match guarantee, free shipping, and global storage options. Thanks for making GoldSilver.com your bullion dealer.
They've been caught red-handed. That term comes from England from hundreds of years ago when people would get caught poaching on the king's land, and if they had blood on their hands, they were guilty. Well, the Federal Reserve, I just love the fact that they publish so much data and information, and that you can go onto their website and you can make charts and so on, because they're incriminating themselves and they have been caught red-handed. This first chart here is U.S. wealth level, and it's all sectors, and this would look like a good thing if times were normal, that it was going up, and it should go up. Mankind gets more efficient at producing goods and services are the true wealth. The currency is just the medium of exchange of true wealth. And so when they create more currency, they are not creating wealth. So this is all of the wealth, and what you see here, it starts going vertical back in the blow-off top of the dot-com bubble, and then that pops, and it goes up during real estate, and that pops. And then it's going up in the almost everything bubble. I call it the almost everything bubble because gold and silver are not in a bubble. They're one of the few things that aren't, and so it isn't the everything bubble. If somebody calls it the everything bubble, they're wrong. And so then you see this level off right at around $100 trillion. It's going bouncing up and down above and below $100 trillion. Well, today, since the pandemic, we're up at $137 trillion, and that is a 37% increase. If your bank account, if your wealth did not go up by 37% in the past two and a half years, then you're falling behind. It would have to go up 37% just to be running in place. Now, this is an increase of $37 trillion. That is $112,000 per person. So if you got a family of four and you're not $450,000 richer, I'm sorry I'm laughing because this is a depressing subject. I'm just laughing because of our insane monetary system and these comical economics that it provides. I mean, we shouldn't be able to have to do this kind of analysis and come up with these idiotic schemes that they've got to steal our wealth, and most people are oblivious to it. But this is a $37 trillion increase, like I said. A family of four, it's about $450,000. What they are doing when they goose the economy, they did it here, they did it a lot during QE 1, 2, and 3, and now we've got the pandemic response. They are cutting the currency supply into smaller and smaller units. When you add units when they type up currency and add that to the currency supply, it means that each unit, if there is not a corresponding rise in goods and services to suck up that excess currency and balance it out, if production of goods and services, GDP is a price of goods and services, so it's affected by price. But if the actual goods and services don't increase to keep up with the quantity of currency in the system, then prices will eventually rise to suck up that excess currency. So this will cause some inflation. So here is the same chart divided by gross domestic product. And you can see that there used to be an equilibrium. This is, most of the 60s, 70s, and it was the late 50s, 60s, and 70s. It was 3 to 3.5 times the annual GDP. So 3 to 5 times 3 to 5 years worth of all the goods and services produced in the economy equaled the same amount as personal wealth, the total personal wealth of the nation measured in dollars. Then we went up to an equilibrium that was about 3.7 years of the economy. And then they started this financially engineered economy, the financialization of the economy. A lot of this is near currency creation. They call it near money. I call it near currency. Stocks are a near currency. It's a highly liquid asset, and you can turn it into cash in just a day or so. You're in a cash position, where you can get it back into your checking account and spend it. And so they goosed that. They did the same thing here for the real estate bubble. Now this is real currency creation. When people take out loans to buy a house, that loan, when you sign the loan document, the bank invents the currency that did not exist a minute ago. They credit it to your checking account, and you then write a check to the buyer or to the seller of the thing that you're buying, and now he has the currency that the bank just loaned, and the bank can't get that back. That's currency that stays in circulation. But here, this crashes, and it's trying to seek equilibrium again. That's all the markets are doing, is they're trying to get balanced so that they're stable. But no, the Federal Reserve doesn't want that. They want to push it into a feel-good bubble, but that feel-good bubble is highly unstable. Now, I want to show you total checkable deposits. These are checking accounts, and you can see they went along here, and there's this slow rise here. This is QE 1, 2, and 3, leveling off at just above 2 trillion. And suddenly, after the pandemic response, we're at 4.715 trillion. Now, this goes back, they stopped publishing this in February of 2021. So this data, this $4.715 trillion is more than a year old at this point. And so they say this series will no longer be updated. This graph, this series is suggested as a substitute. And you click that link, and it has nothing. It's interesting. It's total liquid deposits. So it's currency that's available right now, and it peaks at 13.8 trillion, almost $14 trillion of instantly available currency in some form of account. But it's only 2 years of data starting in May of 2020 and going May to 2022 instead of going all the way back to 1975. And it doesn't have anything, it doesn't seem to have anything to do with this. So we can go to currency component of M1. Now, currency component of M1 would be currency in circulation, but this isn't just currency in circulation. I believe this is also vault cash, so it's different than currency in circulation, but not by much. They're almost identical. Plus, demand deposits. What's a demand deposit? That's a checking account. We're at almost $7 trillion between the two. But I don't want the currency in circulation. You see this slow rise from 140 billion in 1959 up to $1 trillion, just over $1 trillion bucks before the global financial crisis. That is mostly increases in currency in circulation. It's not in checking accounts. And then you've got the QE 1, 2, and 3 and the pandemic response. And we're up at just about 7 trillion on this. What I want to see, though, is the checking accounts. So here's demand deposits. And this goes back to 1975. But you don't see that slow rise up to $1 trillion. And then we have the global financial crisis, and you do see QE 1, 2, and 3. So something is being done very, very differently when it comes to how much currency the public is seeing. This isn't just an increase in base currency. And then the pandemic response, and we're getting close to 5 trillion. So 4.9 trillion. Now, I did the math on this. So 1.5 times 2 is 3, times 3 is 4.5, and here we are at 4.9. So prices have to rise to suck up this excess currency. You can expect that someday in the near future, next few years, unless there is a big crash and a slowing of velocity of the currency, if the number of transactions being made in the economy falls dramatically, if you stop going out for dinner and you stay home and eat rice and beans, then prices may not go up because it's the quantity times the velocity. But what will probably happen here is you can probably expect within the next few years to be paying $10 to $15 for a gallon of gasoline. That is just destiny. Years ago, back in 2008 and 9, I used to give these stage presentations, and I had a slide where I show a pool of water and a sponge in the pool of water. And if you expand the pool of water, the sponge expands to suck up the excess pool of water. The pool of water is the currency supply. The sponge is prices. And so you expand the currency supply, that sponge has to suck up the excess currency supply through rising prices. So there's nothing to see here, folks. Move along. Well, guess what? There is more to see. These checkable deposits are broken down. Now, this goes back to 1980. So this is checkable deposits and currency held by the bottom 50%. So, this is mostly like the working class, the bottom 50%. And you see here that they're at about $100 million here before the pandemic. A little dip down here to 80, but $100 million. And then it's up at 200. So this is 2.76 times the amount of currency in the checking accounts of the people that are going to spend this at the grocery store. This $276 billion is going to get spent at the gas station and grocery stores. And so it's almost 3 times. So gasoline above $10 a gallon is in the cards, unless, like I said, we go into some devastating crash. But what's interesting, this is the bottom 50%. Now let's take a look at the top 1%. And here you are at about $200 billion. Before they went from having $40 billion in their checking accounts, $20 billion. Very, very low. And then this is QE1, 2, and 3, and it leveled off. And here there's a little contraction, but let's just call this $200 billion, $220 billion, something like that, 210, before the response by the Federal Reserve. And what you see here is now we are up at $1,331 billion. That, I believe, I did the math before that, is, I believe, 6.69 times or 6.9 times. I can't remember exactly, but it's huge. And this is not currency that is going to be used at the grocery store. This will inflate some asset prices. Right now, we have something that I have called for a couple of decades now. I've been calling it indeflation. Inflation and deflation happening at once. We have the stock markets crashing and deflating, real estate deflating, while prices at the grocery store and the gas pump are going through the roof. This currency is not going to get spent at the grocery store. It's going to get spent on some assets. But my guess is that this is going to get spent on farmland, on food production, on commodities, on real things that are going into short supply that they're going to need more of. I invested a couple of years ago. I sort of saw this coming. And I bought a farm. I used to call it my little farm, but it's not so little actually, up at the very top of Puerto Rico. We're going to be producing food for Puerto Rico, healthy, organic food. The property hasn't been farmed on since 2006. There haven't been any chemicals put on it. So it qualifies for organic certified farming. And so we're trying to do something called permaculture, which builds the topsoil instead of depleting it. So let's move along. The Fed officials sold all of their stocks to avoid any conflict of interest right here at the top. It was disclosed that they were getting rich, some of them, in their stock portfolios because they have foreknowledge of what is going to happen in the economy because they are the ones that make it happen. And they were trading based on that foreknowledge, which is called insider trading, and they should be in jail for a long time. I mean, if you or I did this, we would go to, I mean, Martha Stewart went to jail for insider trading, I believe. And it was an idiotic thing, but she ended up in jail for trading on her own stock, I believe. So this, we caught the Fed officials red-handed. It is not inflation is not Putin's fault. There's going to be a little bit of this that affects foods and things because of the disruption in supply chains and so on from the war. But the inflation started way before that war started, and so it is not Putin's fault. But I would imagine that right now there's a bunch of politicians hoping that things get politically worse in the world because then they will be able to blame it on somebody else. I mean, I wouldn't put it past the Fed officials to be rooting for full-blown war with multiple countries in it breaking out so that they can blame everything that they did. They got caught red-handed here, but they're hoping that the blood, that they can point to somebody else and go, oh, no. See how you don't see their blood on them? It's invisible blood. They're really the guilty party, ladies and gentlemen. They caused the inflation, not me. So I grew up with Steve Jobs, Johnny Cash, and Bob Hope. Now there's no Jobs, no Cash, and no Hope. Please don't let anything happen to Kevin Bacon. I want to thank you for watching. We'll see you next time.